And something else to think about, the Barclays U.S. Aggregate Bond Index, which is akin to the S&P 500 index only for bonds, was negative in the first quarter, and that is very rare. Here to give us his take on the state of the fixed income market and the challenges that lie ahead for bond investors is Bob Auwaerter. He's the head of fixed income at Vanguard. Welcome, Bob. Nice to have you here. First of all, tell me what you read into this very rare decline in what's called the Ag Index.
Well, what happened in the past 3 months is that really yields in 15-year and longer Treasury and corporate securities just backed up a little bit. Shorter and intermediate yields really were unchanged. So it was a relatively small change which resulted in that slight negative performance.
You know, Bob, a fair number of market watchers are worried about the amount of money that remains in bond funds, particularly in long-term bond funds, particularly in treasuries. They worry that there may be a bubble or that a big bear market may be coming. Do you worry about that?
Well, I think it's certainly a concern given the historically low yields that we're dealing with right now. But don't forget that the Federal Reserve has clearly said by keeping short rates low and by buying a lot of longer-term treasuries that they want yields to remain low. They're acting as a very powerful depressant on the market. And really, I don't see any signs that they're going to be moving off that policy unless we get a pickup in inflation. And I would defy anybody to tell me what sector out in the economy has pricing power right at the moment.
Given that, then, if you want to go into the fixed income market, where do you see some continued opportunity, given the fact that you think rates are going to be on the low side for so much longer?
Sure. That said, there is a risk that rates could move up, and I would stick to short and intermediate maturities in terms of particular sectors that we like right now are banks that are investment grade. If you're a high income tax bracket investor, and unfortunately many of us are with the changes in the tax rules, single A-rated munis look quite attractive. And then finally, this is more for institutional type investors, AAA rated commercial mortgage-backed securities has a good combination of yield and credit quality right at the moment.
You know, a fair number of people have moved into higher yield bonds as the economy has generally been performing reasonably well. Default rates are down, and it is the place where you get higher yield, obviously. That's why they call them high yield bonds. Are there risks there, and is that trade getting crowded?
I definitely think it is. If you look at the absolute yield to maturity or yield to worst that you can buy, it's basically at historic lows right now. You're right, everybody's been piling in, and I'm beginning to wonder if it's looking for yield in all the wrong places. Particularly the junkiest of the junk, the CCC rated bonds have had a very powerful quarter. So I agree with you. I think there's too many people playing in that market right now. I'd be very cautious.
It's interesting, is it not, at the same time that we have the stock market hitting new all-time highs, and in this latest quarter, we also have the 10-year yield down at very, very low levels. And usually you don't see that. These are very unusual times, certainly, but can that dynamic continue?
I think it can because of the Federal Reserve. Chairman Bernanke termed last through January of 2014. And, there's speculation about his successor. I personally think it's going to be Janet Yellen, and she is definitely on board with the same type of monetary policy until the unemployment rate drops significantly. And I think we have a long ways, and it's going to take a long time to get down to unemployment rates that the Fed will be comfortable with starting to tighten monetary policy.
All right, Bob, thank you very much. We appreciate you being with us. Bob Auwaerter, head of fixed income at Vanguard.